Welcome back to the channel. Today we're diving deep into one of the most influential books ever written on investing, The Intelligent Investor by Benjamin Graham. If you want to build wealth, avoid costly mistakes, and master the art of investing, you're in the right place. This video is packed with practical tips, real-world examples, and timeless wisdom that will transform how you think about investing. Benjamin Graham, known as the father of value investing, inspired some of the greatest investors of all time, including Warren Buffett, who called this book by far the best book on investing ever written. So grab a notebook, get comfortable, and let's explore the core lessons of the intelligent investor in detail. Chapter 1. Who is an intelligent investor? To start, let's define what Graham means by an intelligent investor. Surprisingly, it has nothing to do with IQ or being a financial genius. An intelligent investor is someone who focuses on long-term wealth creation instead of chasing quick profits, makes decisions based on facts and analysis, not emotions, understands the difference between price and value. One of the key traits of an intelligent investor is the ability to remain rational, especially during market volatility. Graham emphasizes that emotions like fear and greed are the biggest threats to an investor's success. Understanding risk. Graham argues that risk doesn't come from volatility itself, but from not understanding what you're investing in. Intelligent investors focus on the business behind the stock, not just the stock price. Examples: Warren Buffett's investment in Geico. In 1951, Buffett discovered that Geico's insurance model was superior due to its direct-to-consumer sales approach. Despite Geico facing financial difficulties, Buffett's analysis of its long-term potential led to a $10,000 investment, which eventually turned into billions. John Templeton's strategy. During World War II, Templeton famously bought shares in every company trading under $1 on the New York Stock Exchange during World War II. His contrarian approach and long-term focus paid off significantly after the war. Peter Lynch and Fidelity Magellan. Lynch turned the Fidelity Magellan Fund into the best-performing mutual fund of the 1980s by focusing on undervalued growth stocks that were overlooked by the market. Key takeaway: focus on the intrinsic value of a business rather than getting swayed by market hype. Chapter 2. Investment versus speculation. One of the first distinctions Graham makes is between investment and speculation. Investment: putting your money into assets with the goal of long-term growth based on their intrinsic value. Speculation: betting on short-term price movements without analyzing the underlying business. Intrinsic value versus market price. Investors focus on intrinsic value, which is derived from a company's fundamentals, such as earnings, assets, and growth potential. Speculators, on the other hand, focus on market price, which can be influenced by rumors, trends, and investor sentiment. Historical perspective. During the Roaring '20s, speculation was rampant as investors borrowed money to buy stocks on margin, leading to the 1929 market crash. Graham himself suffered heavy losses, which inspired his focus on value investing and the need for a margin of safety. Some real-world examples: the dot-com bubble, 1999 to 2000. Companies like Pets.com, with no profits or sustainable business models, were trading at sky-high valuations. When the bubble burst, many speculators were wiped out, while value investors who stayed out of the frenzy preserved their capital. Warren Buffett's investment in Burlington Northern. In 2009, amidst fears of a prolonged recession, Buffett bought the railroad giant Burlington Northern Santa Fe for $34 billion. This was a textbook example of investing based on intrinsic value and long-term fundamentals rather than short-term market sentiment. The 1987 crash in Coca-Cola. After the 1987 market crash, Buffett increased his stake in Coca-Cola, recognizing its strong brand and pricing power, even as speculators were fleeing the market. This investment has since paid off exponentially. Key takeaway: invest in businesses, not stocks. Treat them as ownership stakes in real companies. Chapter 3. Defensive versus enterprising investors. Graham identifies two types of investors. The defensive investor aims to preserve capital and minimize risk. Prefers well-established companies with a history of stable dividends. Advocates for a diversified portfolio with a mix of stocks and bonds. Graham suggests defensive investors focus on large, conservatively financed companies with at least 10 years of consistent earnings and dividend payments. Diversification. Holding between 10 to 30 stocks across different sectors can reduce risk without requiring extensive research. Bond allocation. Recommends allocating 25% to 75% of the portfolio to bonds based on market conditions, with 50% being the default for most situations. Examples: Procter & Gamble. Consistent earnings, low debt, and a long history of dividend growth make it a defensive investor favorite. Johnson & Johnson. Its diversified business model across pharmaceuticals, medical devices, and consumer health products adds stability to a defensive portfolio. Another one is the enterprising investor, seeks higher returns by investing in undervalued stocks, willing to do in-depth research and take calculated risks. Looks for opportunities in special situations like spin-offs or market overreactions. Finds special situations. These include mergers, acquisitions, bankruptcies, and spin-offs where stocks might be temporarily undervalued. Looks for net stocks. Graham's original strategy focused on buying stocks trading for less than their net current asset value, providing a margin of safety. While rare today, variations of this strategy are still used by deep value investors. Some examples: Buffett's investment in Washington Post. During a period of media pessimism, Buffett bought shares at a significant discount to their intrinsic value, eventually making over 10 times his investment. Carl Icahn and Apple. Icahn bought Apple shares when they were trading below intrinsic value, pushing for share buybacks to unlock shareholder value. Key takeaway: know yourself as an investor. Choose an approach that suits your knowledge, temperament, and risk tolerance. Chapter 4. Mr. Market, your emotional business partner. One of the most powerful metaphors in the book is Mr. Market, an imaginary business partner who offers to buy or sell your shares every day at different prices. Some days, Mr. Market is overly optimistic and offers high prices. Other days, he's depressed and offers low prices. You can observe Mr. Market as a tool. Graham emphasizes that you should use Mr. Market's irrational behavior to your advantage. When prices are low, it's an opportunity to buy. When prices are high, it might be time to sell or hold. Look at market crashes as opportunities. Rather than panicking during a downturn, Graham advises using these periods to buy high-quality stocks at discounted prices. Some examples: 2008. Financial crisis. Investors who bought stocks like Apple, Amazon, and Microsoft during the crash saw massive returns in the following decade. COVID-19 crash 2020. Companies like Disney and Starbucks saw their stocks drop sharply despite strong fundamentals. Investors who recognized Mr. Market's irrational fear made significant gains by buying these stocks at the lows. Key takeaway: treat the stock market as a tool, not a guide. Stick to your own analysis of a company's value. Chapter 5. Intrinsic value, the true worth of a stock. One of the core concepts in The Intelligent Investor is intrinsic value, the actual worth of a company based on its fundamentals like earnings, assets, and growth prospects. Intrinsic value is independent of a stock's current market price, which can fluctuate wildly due to investor sentiment. Graham argues that investors should buy stocks only when they are trading below their intrinsic value, creating a margin of safety. By buying stocks at a discount to their intrinsic value, investors create a buffer to absorb errors in analysis or unexpected market downturns. Examples: Buffett's investment in American Express, 1964. During the salad oil scandal, American Express shares fell nearly 50%. Buffett analyzed the intrinsic value and realized that the company's core business was unaffected. He invested $13 million, which grew to over $1 billion. Microsoft in early 2000s. After the dot-com bubble burst, Microsoft was trading at a P/E ratio of under 10 despite strong cash flow and a dominant market position. Investors who recognized its intrinsic value earned substantial returns in the following years. Berkshire Hathaway's purchase of Burlington Northern. In 2009, Buffett bought the railroad giant, believing its intrinsic value was far higher than the market price due to its economic moat and cash-generating ability. The investment has since yielded billions. Key takeaway: invest in companies trading below their intrinsic value to maximize returns and minimize risk. Chapter 6. The margin of safety, your investing seatbelt. The margin of safety is one of the most critical concepts in The Intelligent Investor. It means buying stocks for significantly less than their intrinsic value to protect against unforeseen risks. Think of it as an insurance policy that cushions against errors in analysis, market downturns, or unexpected news. Graham advises never to risk what you can't afford to lose, emphasizing that the margin of safety is what separates investors from speculators. In-depth analysis. Calculating margin of safety. If a stock's intrinsic value is $100 but it's trading at $70, the margin of safety is 30%. Graham suggests looking for a margin of safety of at least 30% to 50% to reduce risk. Bonds and margin of safety. Graham also applies this principle to bonds, advising investors to focus on companies with strong balance sheets, low debt, and sufficient cash flow to cover interest payments. Examples. Apple in 2016. Buffett started buying Apple when it was trading at a P/E ratio of around 10, well below the market average. With its strong cash flow and brand loyalty, the margin of safety was significant. Today, that investment is worth over $120 billion. Washington Post, 1970s. Buffett purchased shares at about 1/4 of their intrinsic value during a period of pessimism about the newspaper industry. The margin of safety allowed the investment to grow more than tenfold. The housing crisis, 2008. Investors like Seth Klarman bought mortgage-backed securities at massive discounts, with a substantial margin of safety based on the underlying assets. As the housing market recovered, these investments generated impressive returns. Key takeaway: never risk what you can't afford to lose. Always have a margin of safety. Chapter 7, Mr. Market, Your Emotional Business Partner. One of the most memorable metaphors in the book is Mr. Market, an imaginary business partner who offers to buy or sell your shares every day at different prices. Mr. Market is moody. Some days he's euphoric and offers high prices. Other days he's depressed and offers low prices. Graham's advice? Ignore Mr. Market's mood swings and use them to your advantage by buying when he's fearful and selling when he's greedy. Graham argues that the biggest challenge in investing isn't analyzing stocks but controlling your emotions. Mr. Market embodies the herd mentality of buying high and selling low. Rather than fearing volatility, Graham sees it as an opportunity to buy good companies at bargain prices. The key is to have a sound understanding of a company's intrinsic value. Examples. 2008. Financial crisis. When Mr. Market was severely depressed, stocks of companies like Wells Fargo, Goldman Sachs, and General Electric were trading at historic lows. Buffett's investments in these companies during the crisis have since earned billions. COVID-19 crash, 2020. Mr. Market panicked as stocks plunged in March 2020. Investors who bought companies like Amazon, Apple, and Microsoft at those lows saw massive gains as markets rebounded. The Great Depression, 1929 to 1939. Graham himself made significant investments during the depths of the Great Depression by focusing on intrinsic value rather than market sentiment. His approach led to substantial gains when the market eventually recovered. Key takeaway: treat the stock market as a tool, not a guide. Stick to your own analysis of a company's value. Chapter 8. The Intelligent Investor's Approach to Diversification. Diversification is one of the cornerstones of Graham's investing philosophy. He argues that spreading investments across different sectors and asset classes helps minimize risk without significantly reducing potential returns. Graham recommends holding between 10 to 30 stocks across various industries to achieve adequate diversification. For defensive investors, he suggests a 50-50 split between stocks and bonds to balance risk and reward. Sector diversification. Investing in multiple sectors, such as technology, healthcare, consumer goods, and finance, reduces the impact of a downturn in any single industry. Asset class diversification. By holding a mix of stocks, bonds, and possibly real estate, investors can smooth out returns and protect against market volatility. Geographic diversification. While Graham focused mainly on U.S. stocks, modern value investors often diversify globally to access undervalued markets and reduce country-specific risks. Examples. Ray Dalio's all-weather portfolio. Dalio's portfolio strategy emphasizes diversification across asset classes, including stocks, bonds, commodities, and real estate. The goal is to minimize risk in any economic environment. Berkshire Hathaway. Buffett's portfolio includes investments across railroads, technology, consumer goods, and insurance, exemplifying sector diversification. John Bogle and index funds. Bogle's creation of the first index fund provided an easy way for investors to diversify broadly and cost-effectively. By owning a piece of every company in the index, investors reduce individual stock risk. Key takeaway: diversification is not just about spreading risk. It's about maintaining balance and protecting your portfolio from unforeseen shocks. Chapter 9. Analyzing Financial Statements. The Three Pillars. Graham emphasizes that intelligent investors must understand how to read and interpret financial statements to assess a company's intrinsic value. He focuses on three key documents: the income statement, balance sheet, and cash flow statement. Income statement shows a company's profitability over a specific period. Key metrics are revenue, total income from sales or services; net income, profit after all expenses and taxes; earnings per share, EPS, indicator of profitability for shareholders. Example: Apple's income statement. Apple's consistently growing revenue and net income demonstrate its profitability and operational efficiency. Investors use EPS to assess whether the stock is reasonably priced based on its earnings power. Balance sheet provides a snapshot of a company's financial position at a specific point in time. Key metrics are assets, resources owned by the company, cash, inventory, property; liabilities, financial obligations, debt, accounts payable; shareholder equity, assets minus liabilities representing the net worth of the company. Example: Berkshire Hathaway, known for its strong balance sheet with minimal debt and substantial cash reserves, allowing it to make significant acquisitions during market downturns. Cash flow statement tracks the actual cash generated and used by a company, providing insights into its liquidity. Key metrics are operating cash flow, cash generated from core business activities; investing cash flow, cash spent or received from investments; free cash flow, cash available after capital expenditures, indicating a company's ability to pay dividends or reinvest. Example: Microsoft generates substantial free cash flow, enabling it to fund acquisitions, pay dividends, and repurchase shares. High free cash flow often signals a company's financial health and sustainability. Key takeaway: understanding financial statements is essential to identifying undervalued stocks and avoiding companies with weak fundamentals. Chapter 10. Inflation and Investing. Protecting Your Wealth. Graham warns that inflation is a hidden tax that erodes purchasing power over time. He emphasizes investing in companies with strong brands, pricing power, and the ability to pass on increased costs to customers. Bonds versus stocks. Fixed income investments like bonds are particularly vulnerable to inflation because their returns are fixed. Stocks, on the other hand, offer a better hedge against inflation, especially those of companies that can raise prices without losing customers. Commodity-based investments. Graham suggests considering commodity-related stocks or inflation-protected securities like TIPS, Treasury inflation-protected securities. Dividend stocks. Companies with a history of growing dividends can help offset the impact of inflation on purchasing power. Examples: Coca-Cola, known for its strong pricing power, allowing it to raise prices in line with inflation without losing market share. Real estate investments. Historically, real estate has been a strong hedge against inflation, as property values and rental income tend to rise with inflation. TIPS, Treasury inflation-protected securities, offer a guaranteed return above inflation, providing a safe option for defensive investors. Key takeaway: invest in companies with strong brands and pricing power to protect against inflation's erosion of your purchasing power. Chapter 11. Investing in Bonds, Stability and Income. For defensive investors, Graham emphasizes the importance of bonds for income stability and risk reduction. Recommends a balanced portfolio of 50% stocks and 50% bonds to manage risk. Suggests focusing on high-quality bonds with investment-grade ratings to avoid default risk. There are different types of bonds. Government bonds, lower risk but lower yield, ideal for conservative investors. Corporate bonds, higher risk but higher yield, suitable for enterprising investors. Municipal bonds, tax-free income, beneficial for high-net-worth individuals. Yield spread analysis. Comparing yields on corporate bonds versus government bonds helps investors assess market risk perceptions. Widespread can indicate heightened risk or potential bargains. Bond examples: U.S. Treasury bonds, often considered the safest investments globally, providing stable, guaranteed returns. Berkshire Hathaway's bond holdings. Buffett's portfolio includes a mix of government and high-quality corporate bonds to manage risk, while ensuring liquidity. Junk bonds, high-yield bonds. Michael Milken's development of the junk bond market in the 1980s showed that bonds with higher risk but thorough analysis could yield substantial returns. Key takeaway: bonds add stability and predictable income to your portfolio, especially during stock market downturns. Chapter 12. The Psychology of Investing. Controlling Emotions. Graham emphasizes that the greatest enemy of the investor is likely to be himself. Emotions like fear and greed lead to irrational decisions, often resulting in buying high and selling low. Advocates for a rational, business-like approach to investing, focusing on facts and analysis rather than sentiment. Confirmation bias. Investors tend to favor information that supports their preconceptions and ignore opposing data. Herd mentality. Following the crowd can lead to overpaying for popular stocks or panic selling during downturns. Loss aversion. Studies show that the pain of losing money is twice as powerful as the joy of gaining it, leading to poor decision-making. Some examples. 2008. Financial crisis. Investors who panicked and sold their stocks at the bottom locked in losses, while those who held or bought more during the downturn saw substantial gains. Amazon's early years. Despite temporary losses and market skepticism, investors who focused on Amazon's growing revenue and market share, rather than short-term losses, were richly rewarded. Warren Buffett's, quote, "Be fearful when others are greedy and greedy when others are fearful," encapsulates the importance of controlling emotions. Key takeaway: mastering your emotions is crucial to long-term investing success. Chapter 13. The Defensive Investor's Portfolio. Keeping it simple. Graham dedicates a significant part of the intelligent investor to the defensive investor, someone who wants to minimize risk and maximize peace of mind without dedicating excessive time to managing investments. He recommends a 50-50 split between stocks and bonds to balance risk and return. Emphasizes investing in blue-chip stocks with a long history of stable dividends and earnings. Stock selection criteria for defensive investors. Earnings stability. At least 10 years of continuous profitability. Dividend record. Consistent dividends for at least 20 years. Moderate price-to-earnings (PE) ratio below 20 to avoid overpaying. Financial strength. Debt should not exceed 50% of total assets. Bond allocation. Focuses on investment-grade bonds, AAA to BBB ratings, to minimize default risk. Suggests laddering bonds, buying bonds with different maturities to reduce interest rate risk. Stocks and bonds examples. Coca-Cola. Consistently pays and raises dividends, has a strong balance sheet, and generates substantial free cash flow. Fits Graham's criteria for a defensive investment. Johnson & Johnson. Diversified across pharmaceuticals, medical devices, and consumer health, making it resilient to downturns in any single segment. Vanguard's Total Bond Market Index Fund. A popular choice among defensive investors for broad diversification and low risk. Key takeaway: the defensive investor's primary goal is to preserve capital while earning a reasonable return. Chapter 14. The Enterprising Investor's Strategy. Seeking Value. For enterprising investors willing to put in the time and effort, Graham suggests a more active approach to finding undervalued stocks with higher return potential. This strategy involves special situations, buying stocks involved in mergers, spin-offs, or reorganizations. Undervalued stocks. Looking for stocks trading below their net current asset value. Growth at a reasonable price. Investing in growth stocks only when they are undervalued based on earnings and cash flow. Net stocks. Graham's original strategy involved buying stocks trading for less than their net current assets minus total liabilities. Although rare today, variations like deep value stocks with low PE and PB ratios still follow this principle. Cigar butt investing. Buying stocks that the market has thrown away but still have one last puff of value. While Buffett moved away from this approach, it remains relevant for enterprising investors with a small portfolio. Examples. Buffett's investment in American Express. During the salad oil scandal, Buffett bought American Express at a discount, recognizing its brand value and strong financials. Spin-offs. PayPal's spin-off from eBay created value as the market could better appreciate PayPal's growth potential as an independent company. Seth Klarman's Baupost Group focuses on special situations, including distressed debt and corporate restructurings, to find undervalued opportunities with a margin of safety. Key takeaway: enterprising investors can achieve higher returns by focusing on undervalued stocks and special situations. Chapter 15. Growth stocks versus value stocks, understanding the difference. Graham makes a clear distinction between growth stocks and value stocks. Growth stocks. Companies expected to grow earnings faster than the market average. They typically trade at high P/E ratios. Value stocks. Companies trading below their intrinsic value, often due to temporary problems or being overlooked by the market. Risk versus reward. Growth stocks offer higher potential returns, but also higher risk if growth projections don't materialize. Value stocks provide a margin of safety, reducing risk but often requiring more patience. Examples. Amazon. Initially perceived as overvalued with a high P/E ratio, its consistent revenue growth and reinvestment strategy validated its growth stock status. Berkshire Hathaway's investment in Apple. Despite being considered a tech company, Buffett viewed Apple as a consumer goods company with strong brand loyalty and pricing power. A classic value investment despite its growth characteristics. Philip Morris. Traded at low P/E ratios due to regulatory and litigation risks, but offered high dividends and consistent earnings growth, making it attractive for value investors. Key takeaway: understanding the difference between growth and value stocks helps investors make informed decisions based on risk tolerance and investment goals. Chapter 16: Common Mistakes to Avoid. Graham's Warnings. Graham warns investors against common pitfalls that can derail even the most well-thought-out strategies. These include market timing. Trying to predict short-term price movements is nearly impossible. Chasing performance. Investing based on past performance alone without considering fundamentals. Speculative IPOs. Most IPOs are priced for maximum hype, not long-term value. Leverage. Borrowing money to invest can amplify losses, especially during downturns. Behavioral biases such as overconfidence. Believing you can consistently beat the market leads to excessive trading and higher fees. Recency bias. Overemphasizing recent events at the expense of long-term fundamentals. Avoiding the crowd. Graham emphasizes contrarian investing, buying when others are fearful and selling when they're greedy. Following the crowd often leads to buying high and selling low. Some examples. Lehman Brothers, 2008. Over-leveraged with risky mortgage-backed securities, leading to its collapse during the financial crisis. Snapchat IPO, 2017. Priced high based on user growth, but investors who ignored fundamentals faced losses as growth slowed. Dot-com bubble. Investors chased performance based on rising prices without considering the lack of profitability. Key takeaway: avoiding common mistakes is just as important as choosing the right stocks. Chapter 17, The Timeless Wisdom of Benjamin Graham, Final Lessons. As we wrap up this deep dive into the intelligent investor, let's revisit some of Graham's most timeless lessons. Invest with a margin of safety. Always buy with a significant discount to intrinsic value to protect against errors. Embrace long-term thinking. Focus on a company's fundamentals, not short-term price movements. Control your emotions. Staying rational and disciplined is often more important than choosing the perfect stock. Diversify strategically. Spread investments across sectors and asset classes to reduce risk. Avoid speculation. Treat stocks as ownership stakes in real businesses, not lottery tickets. Key takeaway: by following these principles, you can build wealth steadily while minimizing risk and avoiding costly mistakes. And that's a wrap on The Intelligent Investor by Benjamin Graham. If you found this summary helpful, don't forget to like, subscribe, and hit the bell icon for more investing insights. Thanks for watching, and until next time, keep investing wisely.